Hi everybody, and here's our video for chapter 2 where we're getting into the exciting, maybe that's not the right word, but getting into the real accounting stuff here. So we talked about accounts in this one, and we've mentioned accounts. We've mentioned a lot of different accounts in chapter 1. An account is where we record all of the increases and decreases in the balance of a specific asset, liability, or part of capital or equity. Let's see. Equity. So examples of asset accounts that we've talked about: cash, land, equipment, buildings, supplies, anything that we own. Also anything with receivable in the name. That means that's cash that we are going to receive. So accounts receivable. Sometimes you might see interest receivable, but anything with receivable in the name is an asset. There's certain keywords we can look for in some of these, even if you don't know exactly what it is. If you see certain keywords, you can tell. And the other one, the other keyword you'll see is prepaid. So for instance, you'll see prepaid insurance, and this means we paid for it in advance. If you think of assets as anything that you can convert to cash, you pay your insurance, your car insurance, probably 6 months in advance. And if you're 2 months into it, you've used 2 months worth of what you paid, but the other 4 months, they either owe you insurance, or if you canceled it, you could get your money back, in theory. So you could turn that into cash. So in prepaid insurance or any prepaid expense, sometimes you see prepaid rent, it's anything that you paid for in advance. Liabilities. Types of accounts we've seen there. Accounts payable is the main one we've seen, but really anything with payable in the name. So here, let's highlight receivable and prepaid as important keywords for assets. Accounts payable, you'll see notes payable. You might see taxes payable. So anything with payable in the name. And then the other keyword that we see here is a type of liability that we'll see is unearned revenue. So the insurance, for example, when we paid that, for us that was an asset, that prepaid insurance. But for the business that we paid it to, the insurance company, that's a liability. They've been paid for something in advance, but they haven't provided it yet. So they either owe the services or they owe the money back. They owe something there. So unearned is a keyword for, let's turn that highlighter on and make that a different color, blue. So, payable or unearned. Those two keywords tell us that it is a liability. And then equity, we've already talked about the 4 different types of accounts we see in equity. So that's capital, is when the owner puts money in, and withdrawals, when the owner takes money out, and then revenue, when the business makes money doing whatever it does, and expenses that the business incurs in order to generate those revenues. So those are the 4 types of accounts we see there. So this is one of the practice problems in the demos. Notes receivable. I see the word receivable, so I know that's an asset. Capital is part of the equity account. Prepaid is one of those keywords, so I know that's an asset. Notes payable. As soon as I see the word payable, I know it's a liability. Rent revenue. Revenue is always part of equity. Taxes payable. I see payable, I know it's a liability. An expense, well, revenues and expenses pretty much always have that word right in the name for you. So rent expense is part of equity. Furniture is something I own, so that's an asset. Withdrawals are part of equity, and then unearned revenue. Normally you would key on the word revenue, but unearned is the one that's important here. I haven't earned that revenue yet, so that's a liability. So once we become a little more familiar with the types of accounts, we move on to double entry accounting system. And we saw this when we were looking at transactions in terms of the accounting equation, right? There were always at least two accounts affected. Something's going up and something's going down, or sometimes two things are going up or two things are going down, to make sure that the accounting equation is still in balance. So we always have at least two accounts affected by the transaction. And that's what keeps our accounting equation in balance. And a lot of times we see this, we look at what we call a T account. And we're going to do quite a few of those this time. A T account is kind of a learning tool. You'll become very familiar with it, unfortunately. So T accounts will have the account name up here, and then the left side is a debit and the right side is a credit. That's how that always works. So this is where we translate. Last chapter we said, is the balance going up or down? Well, now we're translating that up or down into debits and credits. And so a lot of people think credit's good, debit's bad, or the other way around, and that's not the case at all. And whether a debit increases or decreases account depends on the type of account. So we go back to our friend from chapter 1, the accounting equation. Assets equal liabilities plus owner's equity. And so for each of these types of accounts, we would have a T account. The debit's always on the left, the credit's always on the right. Debit, credit. For an asset, if the balance is increasing, that's a debit, and if it's decreasing, that's a credit. DR, you might, if you didn't read the chapter yet, DR is the abbreviation for debit, even though there's no R in the word debit, and it has something to do with the original Latin word for it or something like that. But that's generally what you see is DR for debit. If this equal sign becomes a mirror, then the things on the opposite side of the equation look the opposite of an asset. So a credit is what I do to increase it, and a debit decreases it. And the same thing for owner's equity. A credit increases it, and a debit decreases it. So for some accounts, if I increase it, I debit, and for others, if I increase it, I credit. And it depends which side of the accounting equation it falls on. So just to do kind of a couple examples of those, asset equals liability plus owner's equity. And let's say I received $500 cash for services rendered. So which two accounts? I received cash, that's an asset, right? So I said in here, a debit is a plus and a credit is a minus. And it's the opposite for these guys, right? A debit is a minus, a credit is a plus, debit minus, and credit adds to it. So if I received cash, that asset of cash is increasing, so that's the debit. So I would put the 500 over here. If I received it for services, that's part of revenue. Revenue adds to equity, so that should be over here on the credit side. And so I've got one debit and one credit, and the accounting equation is still in balance. If I paid $300 on my accounts payable, which two accounts are affected? Cash and accounts payable. I paid cash, so cash is going down. If cash is going down, that should be the credit. So I'm going to put $300 on the credit side. If I paid on the liability is going down. I don't owe as much money now. So think of the balance and the liability as my balance, what I owe. If I made a payment, I don't owe as much. If a liability is decreasing, that's a debit. So one debit, one credit. Just one more. Let's say I paid $100 rent. As soon as I see paid, I know that's cash, that's an asset, and it's going down. So that's going to be my credit. And then I should have a debit. An expense subtracts from owner's equity, so that should be a debit. And that's $300, like that. Sometimes you can have one. Let's do one more. I paid $100 for supplies. Well, as soon as I see paid, I know that the asset cash went down. To decrease an asset, I credit it. But office supplies is also an asset, and I bought office supplies, so I added those. So there's a $100 debit, and the account equation is still in balance. So let's take this accounting equation that we had, and let's expand that just a little bit more. So I know that assets on the debit side, it's an increase, and on the credit side, that's a decrease to an asset. For liabilities, it's the opposite, right? The debit, if I debit a liability, that's a decrease. If I credit it, that's an increase. Now, I'm going to take that owner's equity, and I said on the last slide that owner's equity looks just like the liability. A debit is a decrease, and a credit is an increase, right? But we know we have 4 different types of accounts in the owner's equity. So I've got capital. Withdrawals, however, are a minus, right? Withdrawals take away from owner's equity. Revenue adds to owner's equity. That's a plus there, sorry. Plus revenue. And then expenses take away from owner's equity. So the 2 things that add to owner's equity, capital and revenue, look just like I said owner's equity looks like. A debit is a minus and a credit is a plus. Debit would be a minus, credit is a plus. But withdrawals and expenses, those 2 things take away from owner's equity, so those actually are the opposite of owner's equity, which means they look like an asset. So a debit adds to it, and same for expenses, and a credit subtracts. So what we actually have here, let's change this to blue. For assets, withdrawals, and expenses, so for the blue, a debit is what I do to increase it, and a credit is what I do to decrease the balance in the account. For the other 3 types of accounts, liabilities, capital, and revenue, a debit will decrease the account, and a credit will add to the balance or increase the balance in that account. So I think looking at it in terms of the accounting equation helps you understand why sometimes a debit is an increase and sometimes a debit is a decrease in the balance. But if that doesn't make sense, you can just keep this little chart handy and use it while you're doing your journal entries, because you don't really have to memorize it, right? And so I think it helps me to remember why sometimes I debit, sometimes I credit. But if it doesn't make sense, you can still just keep this handy and just refer back to it. You also want to remember that you will always have at least 1 debit and 1 credit. You can have more than 1 each, but you have to have at least 1 of each. And no matter how many you have, for each transaction, your total debits must equal total credits. And there is never a time when that would not be the case. That's how we make sure our accounting equation stays in balance. So here is some slides. These are actually out of the book here. And so this is just a neater version of what I just wrote. So we said assets withdrawals, and expenses all look the same. A debit to increase it, a credit to decrease it. The normal balance, so some of these, cash, for example, there's money coming in, there's money coming out, but the balance in the account always has to be whatever you do to increase it. So assets, withdrawals, and expenses have a normal balance that is a debit, because that's what I do to increase those. And for the other three types of accounts, liabilities, capital, and revenues, the normal balance is on the credit side, because in order to increase those accounts, I credit it. The other thing I'm going to tell you here, liabilities and assets go up and down, you debit and credit it all the time. But these other guys, the ones that are in equity, I want to write this kind of small because I don't want to make it too dark. Here, I'll make it that. A capital, you will pretty much only credit it. You will pretty much never debit a capital, nor would you credit a withdrawal. It's like these two go together. So if you're adding to it, it's capital. If you're subtracting from it, it's withdrawals. So unless you're fixing an error, you'll never do that. And we got the same thing with here. If I'm adding to revenues, I credit it. So you should almost never see a debit to a revenue or a credit to an expense, because it's kind of like these two are two sides of the same coin. And so if it's a positive, I call it a revenue. If it's a negative, I call it expense. So you won't see debits and credits in those guys. So after a while, that comes in handy. You can say, as soon as you see an expense, that's the debit, because we don't, unless you're fixing some sort of error or doing something odd, but you won't have anything like that coming up soon. And here's another way. This is the same information in a chart form instead of the accounting equation. And like I said, if that makes more sense to you, you can memorize it, you can keep it handy, you can use that and just keep referring back to it. So this is just a couple practice problems here. For each type of account, you would say whether this would be recorded as a debit or a credit. So an increase to accounts receivable. I know that accounts receivable is an asset, so to increase that, I would debit it. I'll try to write that out. Unearned revenue. Unearned means it's a liability. So to decrease that, I would debit it. And again, you can go back to this chart. And so you say, okay, I know that's an asset and it's increasing, so I debit it. I know that unearned revenue is a liability and I'm decreasing it, so that is a debit. And so just keep going back to this chart. At first it'll be kind of slow, but the more you do it, the faster it goes. Cash is an asset, so to decrease that, that's an asset, so I debit that to decrease it. Interest expense, it's got expense right here in the name. So every time I see that, I know it's a debit. Increase to salaries payable. I see payable, I know it's a liability. To increase it, I credit it. Prepaid rent, I know that's an asset. To decrease that asset, I credit it. Capital is an increase, and if we go back to our chart, capital, here's capital. To increase it, I credit it. Notes receivable. I receive receivable. I know it's an asset. So to increase an asset, I debit that account. Accounts payable is a liability. To decrease it would be a debit. And interest revenue. I see revenue. I know that's going to be a credit. And then again, the normal balance, this means whatever I do to increase it. So liability will always have a credit balance. Withdrawals will always have a debit balance. Revenue, credit. Again, you can just go back here to this part of the chart. So as long as you can identify which type of account it is, you can look at your chart and figure out where your normal balance is. Land is an asset, so that has to have a debit balance. Unearned revenue is a liability, so that'll have a credit balance. Again, the more problems you do, the more, and then there's kind of a lot of homework in this chapter, but the more you do, the less you have to think about these, and you get used to these account names, you get used to looking for these keywords. Capital will always have a credit balance. Utilities expense. As soon as I see expense, I know that's going to be a debit. Office supplies is an asset, so that has a debit balance. Advertising expense, I see that word expense, I know it's a debit. And interest payable, I see payable, I know it's a liability, and that has to have a credit balance. All right, recording transactions. So the way this kind of works, some sort of activity or transaction occurs. I make a sale, I buy inventory, I pay a bill, anything like that. It will have some sort of source document. So an invoice or a purchase order or a bill that comes in or a sales receipt or something. Then the transaction is analyzed. Analyzed. That's going to have 5 steps to it, and we're going to talk about that next. And part of those steps, once I analyze the transaction, then I'm going to record it in the journal. And then I'm going to post it to the ledger. So let's talk about those two real quick. The ledger, well, let me talk about the journal first. Sorry about that. The journal is a chronological record of all the transactions all the activities for this business by date. So it's like a little diary. And so it just has in chronological order, here's what happened. The ledger, the info is transferred from the journal to each account. And they've got this system of cross-referencing. And they're both important in their own way. So the journal keeps track of everything, but let's say I need to figure out what the balance is in cash. I don't want to have to go through 6 pages of journal entries, look for all the increases to cash, all the decreases to cash, and add them all up and figure out my cash balance. So the ledger shows all the activity related to one specific account, and it keeps a running total of the balance. So that's the other important part there. It keeps a running total of the balance in that account. But I don't want just that one either, because if I look at that, so that would be like your checkbook if you keep your register. All the times you added money, all the times you took money out, and then each time you calculate the new balance. But let's say I'm looking at that and I see this check for $5,000, and I don't know what that was for, because all I have is the date and the amount. So there's a part on the ledger then that cross-references back to the journal. And so it says, okay, to get more information on this one, go to page 5 of the journal. So then you can go to page 5 of the journal, and then you can figure out what that check was written for. Probably has an invoice number and all that kind of stuff. So it's got this, so different. They tell you different things, but they're both important to answer different questions. This is what a journal looks like. So we have the date of the transaction here. We have the 2, and there's always going to be at least 2 accounts affected. We write the debit first. So we always write the debit first. And then the amount here in the debit column. And then I indent and put the second account that's affected, the credit, over here. And when you're putting them in MyLab, once you put it, you'll be selecting from little drop-down menus here, right? And once you put it over here on the credit side and hit enter, it will automatically kind of indent that for you. So you don't have to worry about that. The credits and debits must equal each other, right? If I had more than one, the total debits have to equal the total credits. And then I put an explanation. If you were doing this for you would probably have like invoice numbers or check numbers, that kind of thing for cross-referencing. But it always goes in this order, and we always put the debit first and then the credit. If it's all mixed in, would be really hard for somebody else to go looking through this journal and kind of figure out what happened here. So we have to keep it nice and orderly so that people can tell what's going on. So I think I will probably end this video here, and then in the next one we'll actually work through some journal entries there and the steps to analyze that. So I will be back with part 2 here in a minute.